With bond yields down, what should you do with the fixed income portion of your portfolio? Let's talk with Jeffrey Katz. He's the managing director at TCW. He runs the TCW Flexible Income ETF. That's a fixed income fund that's been benefiting all from that recent equity volatility that we've been seeing. Jeff, we have heightened volatility. We have heightened concerns about inflation and tariffs. Where does this all fit into a bond portfolio? Are bonds a safe haven right now?
Appreciate it, Bob. Thank you for having me here today. Yes, bonds actually are a safe haven. You look at bond yields relative to a couple years ago, 10-year at 50 basis points wasn't so attractive. Today, investors are coming to bonds looking for income and looking for some buffer from the volatility.
So there's definitely been some panic buying in bonds. Here at ETF Edge, we follow flows very, very carefully. Fixed income flows have picked up rather dramatically in the last month or so. They're almost rivaling flows into equity ETFs, and that's very unusual to see that fixed income flows so strong. Should investors be increasing their allocation to bonds at this point?
We think that they should. You look at correlations. I think the 60-40 portfolio and fixed income is doing its part. There was a lot of conversation and narrative about that not being the case prior to yields coming up. And so I think, that fixed income is performing as it should with a lower correlation and a buffer for volatility.
So you run, I want to get into the specifics, you run an active bond fund. It invests in treasuries, mortgage-backed securities, corporates, asset-backed securities, really the whole range of investments. What parts of the credit market are you overweight and enthusiastic about? What parts are you underweight?
Sure. So you're speaking to Flexer, which is our multi-sector income fund. Parts of the credit markets don't look attractive to us today, given our broader macroeconomic view. We do think that the labor market's slowing. We're leaning into securitized, and so parts of the securitized market look very attractive to us. Would be agency mortgages, mortgage credit, commercial mortgages, oddly enough, given some of the disruption we've seen over the last couple of years, and parts of the asset-backed securities market.
And that's data centers, for example. You've invested in those. Why are data centers so attractive as an investment right now?
Sure. So we have a pretty strong secular tailwind from the AI boom, in addition to some of the cloud storage demand. And so we've seen about a $35 billion in issuance in the data center market. You can buy investment-grade, high-quality assets that trade 1.5 to 2 points incremental yield to treasuries. And so it's a very attractive.
And very briefly, you're underweight corporate treasuries.
Correct. We're underweight corporate treasuries, corporate securities. Spreads look very tight to us. Really need to have the soft landing, no landing narrative come to fruition. Again, our expectation is that something outside of that would materialize.
Jeff, thank you. We're going to have a lot more on this, much more coming up on where to invest the fixed income portion of your portfolio. That's coming up on ETF Edge. That's 1:10 p.m. Eastern Time. Jeff is going to be joined by Alex Morris. He's the CEO of FM Investments. And we'll talk Treasury ETFs as well as residential and commercial mortgages ETFs and asset-backed securities like data centers. That's etfedge.cnbc.com.